With the advent of 401k plans in recent years, the traditional employee retirement pension has fallen out of favor. However, there are still millions of retirees who still receive one. For most of these people, their pensions are fully taxable, but for some pensioners who made after-tax contributions to their pension plans while working, some of their monthly payments are not taxable. If that's the case for you, how do you determine how much of your pension is taxable? I'm going to answer that question in this video. I'm the Tax Geek, and here are your taxes oversimplified. The first thing to keep in mind is that if you've never contributed after-tax dollars to your pension plan, all of it is taxable. On your 1099-R, both boxes 1 and 2A should show the same figure. These figures are entered on lines 5A and 5B of your Form 1040. If this situation applies to you, you needn't watch the rest of the video, unless you want to. Despite the disappearance of traditional pension plans in recent years, there are still a large number of retirees receiving payments from contributory pensions, including most federal retirees, large numbers of retirees from state and local governments, anyone covered under the Railroad Retirement Act, and retirees who contributed to a pension plan through a union. How do you know if your pension payments are partially non-taxable? The clues are on your 1099-R or RRB 1099-R. We'll take a more in-depth look at railroad retirement in another video, so just for now we'll focus on this 1099-R form. First of all, notice that on this 1099-R, box 2A is blank, and box 2B is checked to indicate the taxable amount has not been determined. As I've said in earlier videos, if box 2A is blank, it does not indicate that the amount is 0. There is also an amount in box 9B showing the total amount of employee contributions. This is often referred to as the recipient's cost in the plan. We'll need this figure along with some additional information to determine how much of the pension is taxable. Sometimes the payer has all the information it needs to calculate how much of your pension is taxable. What they often do in this instance is calculate the taxable amount for you and report the amount in box 2A. If that's the case, all you have to do is enter the total amount of the pension on line 5A of your 1040 and the taxable portion of the pension on line 5B. You can now go along your merry way, since the remaining information in this video does not apply to you. But what if you are the recipient of a contributory pension and box 2A is blank? How do you determine how much of that pension is taxable? It has everything to do with those employee contributions in box 9B. Those contributions have to be recovered equally every month for the estimated lifetime of the recipient. This reduces the taxable amount of the pension. This recovery is done using something called the Simplified method. To calculate the non-taxable portion of a contributory pension using the Simplified method, you need to know 3 things in addition to the recipient's cost in the plan. 1. Whether the payments are made for the life of the recipient, called a life annuity, or the life of the recipient and a surviving beneficiary, otherwise called a joint and survivor annuity. 2. The age of the recipient at the time he or she started receiving payments, and the age of the beneficiary when the recipient started receiving payments if the pension is a joint and survivor annuity. And 3. How many payments the recipient received in the current year. Notice that 2 factors do not come into play: the recipient's present age and the total amount of the pension payments. To determine how much of the contributions have to be recovered for each monthly payment, one of 2 tables are used. Table 1 is used for life annuities, and Table 2 is used for joint and survivor annuities. Table 1 uses the age of the recipient as of the date the payment started, and Table 2 uses the combined ages of the recipient and beneficiary as of the date the payment started to determine the number of months over which the contributions must be recovered. Let's see how the Simplified method works with some examples. Edmund retired in March of 2019 at the age of 65 and started receiving a life annuity at that time. Here we see his 1099-R with $35,200 in box 1 and employee contributions of $52,300 in box 9B. Using Table 1, he determines that his contributions should be recovered over 260 months, so he divides his contributions by 260, resulting in $201. This is the portion of each monthly pension payment that is not taxable. Multiply this figure by the 12 monthly payments he received in 2022 to arrive at a total non-taxable amount of $2,412. Subtracting this figure from the total of his payments gives him a taxable amount of $32,788. Alternatively, if Edmund were married to Mary, who was age 58 when he started receiving pension payments under a joint and survivor annuity, he would combine his and Mary's ages when the payment started and use Table 2 to determine the number of months over which to recover his contributions. His and Mary's combined ages on the date payment started is 123, so the contributions must be divided by 310 to determine the non-taxable portion of the payments, which in this case is $169 per month. Multiplying this figure by 12 and subtracting the result from the total pension of $35,200 gives a taxable amount of $33,172. In both cases, the total pension is entered on line 5A of the 1040 and the taxable amount on line 5B. It is important to note that once the monthly non-taxable amount of the pension is calculated, it never changes. It doesn't change as the recipients get older, and it doesn't change if the total amount of the pension payments change. If Edmund were to live longer than 260 months after his initial pension payment, his contributions would be entirely recovered and any additional payments would be fully taxable. If Edmund or Mary were to die before the contributions were fully recovered, any remaining unrecovered cost would be recovered on Edmund or Mary's final tax return. To calculate the non-taxable portion of a contributory pension and keep track of any unrecovered cost, this simplified method worksheet should be completed every year and kept with your records. Here is Edmund and Mary's simplified method worksheet for 2022. Of course, there are many other factors that can go into determining the taxable amount of a pension, but this video describes the most common situations. Additional information and resources can be found in the video description. If you found this video informative, please give it a thumbs up and share it with anyone who would find it useful. Subscribing to the channel and clicking the bell lets you know about new Tax Geek videos as soon as they're released. And of course, your questions, comments, and suggestions are always welcome in the comment space below. Thanks for watching, and I'll be back soon with more of your taxes oversimplified.